So welcome to another video of ours. Today we're gonna have another type of video. Well, at least gonna be the same format, but I mean, we thought it would be a good idea to talk about the passing of Charlie Munger. Of course, he was a avid or a value investor, and Kirill and I had a lot of inspiration from him when we were, yeah, just learning the ropes. Basically, I think everyone who is also watching this video has been in contact with him through video in some way, shape, or form. Uh, and for me, it was just basically watching all his interviews together with, with Warren during his shareholder meetings of Berkshire Hathaway, and uh, just a lot of good insights that he provided, a lot of good knowledge and basic strategies on how to, stay rational and making good decisions. What do you think? What did you get
Yeah,
out of it?
I feel like it's very big loss. Of course, like he lived a great long life. I hope it's something a lot of people are gonna remember for sure. All his inputs, both with Warren Buffett, working at Berkshire and providing all these valuable insights over the years, right? And how to stay rational. That's also a lot that was had influence on my investing lifestyle as well. Sometimes in the very beginning, I was more like, oh yeah, let's just play around, let's just do some day trading and whatever, right? And then at some point, the more I started listening to these two guys, the more I started to understand, their philosophy. And I hope that his legacy is still gonna go into the years into the
Mhm.
future. So yeah.
For sure. Yeah, and I think you summed up perfectly. So yeah, it's a sad loss. This Tuesday the news broke, and I think we all were kind of shocked. I mean, Warren and Charlie aren't the youngest around, but still, it's something you hope that won't happen in anytime soon, right? So
Exactly.
yeah,
It's like your a friend which you grew up with. He was always around, even though you couldn't have seen each other for years, right? But it's like there. It's like a constant, And then
yeah,
when these
completely.
things happen, and it's quite shocking. It's quite shocking. Even though like of course we've never like seen them personally, right? But like by even watching the annual meetings of Berkshire, right, and following all of their wisdoms and interviews, it's already feels like you already knew the person,
Hmm.
yourself. Even though that
Yeah,
was not happening, but yeah,
and they have so much material, right? So
yeah,
uh, hours of material of them speaking and giving knowledge. So I see where
exactly.
you're coming from. Yeah, it's a sad day. And then, yeah, what we want to see today is what that will do to the share price of Berkshire, but also the value, right? Because it's one of yeah the main masterminds behind it. But we can already pull up Berkshire and see what it did.
Yeah, that's actually, yeah, you're right, because the thing is, when it gets to, let's say, Berkshire Hathaway as a company, right? Even though it's a very well diversified business, right, and they have very great business model, but a lot of the let's say core revenue streams are their investing portfolio, right? And the people who are actually managing them were Warren, of course, and then Charlie, right? Of course, they have their lieutenants. They're
Lieutenant.
yeah, lieutenants. Sorry. English is not my main language either, so but yeah, so it's also like it's about time for this generation change within the
Yeah,
company as well. So it's very important to actually understand like what kind of a big small impact it may have on the company if you would like, for
exactly.
example, to invest in it. Yeah.
And also, so they of course also understand their age, right? So Warren and also Charlie have been looking for replacements for a long time already, and I believe that they were already in place for quite some time.
Yeah, yeah. They already brought up some of the people, let's say, to the work, to the operational work, right? But it's not something like they can already have major influence in terms of the like making the investment decisions. Like for instance, I think one of the lieutenants, for example, made the decision to invest in Activision. when there was the acquisition of the company by Microsoft. When the talks were
Yeah.
around there. So it was not the decision of Warren or Charlie. So they already start getting, let's say, up to speed. But yeah, the question is how much time is it gonna take? How, let's say, well their performance would be in comparison to these two giants, right? So
Yeah.
yeah,
And also, how much are you buying into the philosophy, right? If you're buying Berkshire, you're buying basically just Warren being at the helm of some kind of ETF or whatever, right? Because that's what you're buying. And when one of those two giants fade away, uh, are they able to live up to the same, let's say, hype or mentality? So that's something that we need to see over time. It's something we cannot plan for now, but maybe something we should keep in mind when we estimate growth rates and whatever.
yeah, exactly,
So,
exactly, yeah,
so let's dive into it. So as you already mentioned, Kirill, yeah, Berkshire, it's known for, among other, Geico, right? They have a big portfolio. They have a big investment in Coke, Apple. And the thing with Berkshire is that whenever they like a company, they buy most of it, or at least a big portion. That's their whole philosophy, buying stocks for good value and keeping them forever. So let's see what that did for them. So we can here see the statistics, right? So
yeah.
um,
And the thing is, what everybody's got to understand, that Berkshire is not your average company. And if you would like to dive
mhm,
into the numbers, they're also going to be more or less all over the place. So if you, for example, go to the company foundations, right, you can see quite a few red check marks, red crosses. But that doesn't necessarily mean that the company is bad. So, for example, the company has never paid a dividend. So this is also what Robin just mentioned, is part of their philosophy. Instead of them providing you with dividends which are taxable on top of it, they would rather just do it in terms of share buybacks
yeah,
whenever it's applicable. When it gets to, let's say, for example, these fluctuations in net income and free cash flow growth, again, this is also because of the fact that these guys are not constrained by any investors wanting very quick returns. They can take their time to build up certain positions. They can get into negatives, and that's fine. They are completely okay with that. And this is also something
yeah,
which you also need to be fine with.
yeah. Yeah, so then for the foundations, real quick, we can just see that their revenue has been growing, and then the net income growth not so much, free cash flow growth, and yeah, share buybacks is something that is really good. So this is already a good signal because the share buybacks are, well, pretty substantial, right? It's almost at 3%, which is quite considerable.
Yep.
So that also gives a signal to the investor that they have a lot of yeah, commitment into their own holdings, into their own company, and they are predicting that's going to do well.
Yep. So the idea, let's say, of if you would like to own Berkshire, you also got to understand this is not the company which is going to be offering you quick returns right away. They're not consistent with that, meaning they would rather start building up position for the long term just because they feel like this is the right company to own. And this is
Yeah.
also something you got to be comfortable with. If the market is doing bad, if the company is doing bad in the initial stages, you gotta hustle through it. That's the
Yeah.
thing.
And also, for example, here you see the free cash flow growth is a negative check mark, but that mainly comes because between 2021 and 2022 they had a big drop in free cash flow, and it's probably because they needed to buy some more shares, I believe, because prices were down low. There was a lot of conflict in the world.
So the thing is, it's
So
twofold, right? So first of all, you got their let's say operational businesses that Berkshire owns, right? So for example, they own insurance business, right? They
mhm,
own some railroads, etc., right? So first of all, these let's say financial sector is all, of course, not doing well by default because of economic situation.
yeah,
Second of all, the railroads also because of let's say a little bit of a slowdown in the economy are also not doing very well, and it takes a little bit time to for them to speed up. And then also they started investing heavily into the other positions. For example, Occidental Petroleum, right? So Berkshire started to building up this position quite quickly in these times in this time frame. So that could also impact the these metrics.
yeah, exactly. So yeah, that's something that you can observe, and so just on the rationale. So for you, if you see these check marks, it's for you a quick overview because they can be, of course, all green, and it's easier for you to skip, but it's also good to just see what's happening actually in the income statements that you can see over here. All right, I think that's something that we needed to discuss. Let's go down and check out some more stuff. Yeah, so their net earnings ratio, it's pretty good overall, except for we talked about 2022, right? But everything else is in the green. Low interest expense ratios, no research and development. Of course, it's basically a holding company, so that makes a lot of sense. They do have selling and general expense ratios. So do you think it's just these are the annual meeting expenses, 14% of?
That's gotta be the very expensive annual meetings. No, but to be honest, this is since I do not hold Berkshire stock, I didn't look into it myself. But that's actually a very good question. So what exactly is underlying under this expense item? It's still not a lot. It's below the market average, which is good to see, right? Of course. But then again, if you can see over the past 3 years, it also kind of increased a little bit. So maybe something for you to have a look into. What's the reason behind it? Yeah.
Exactly. Depreciation 0. Just him and his newspaper. No, just kidding. Like Warren Buffett these days also increased in tech, but still, it's like it's not a lot going on. It's just asset management basically.
Yeah, but then again, they do not. So let's say the depreciation and amortization could be on the books of the companies they hold, right? Because for Berkshire on its own, as you say, it's a holding company, asset light. It's literally just Charlie used to be Charlie and Warren, and his colleagues, more or less. Maybe a couple of buildings on top of that. So it's peanuts. It's not a lot.
Exactly. So we can also see change in free cash flow per share outstanding, basically similar movements as we've seen before, and no surprise there. Just to see that on average it grew over the past and has been growing up until the point that we discussed, so 2021.
Yeah.
And then of course we see the same metrics that we have seen before. So I think we can skip these.
Exactly.
Overall shares outstanding change. Just consistent share buybacks is something that might be worthy to note.
So this is a very good example. For example, even though our tool is rather standardized for the majority of the companies out there on the stock market, right? This is an exception. So you gotta understand first of all what's the business model behind Berkshire, how they're doing things, right? And then based on that, try to do your judgment. So this is also important.
And that's also why we keep saying, of course, that you have to do your own due diligence and you shouldn't make any decisions on what we are saying here.
Not the financial advice, exactly.
Not the financial advice.
Yeah. Yep.
Okay, let's move down. So Fundsmith, so these again is
same story. Yeah, we could probably disregard that as well, just because of, let's say, this specificity of the business, right? You cannot really even if we go all the way up, right? We check, for example, return on invested capital for the past. I think that's for the past year is -4%, right? But who cares? If you would like to hold Berkshire for, let's say, 10, 20 years into the future, if you look at their past performance, they are beating the market consistently. Period. That's why you're getting Berkshire stock. If you understand their philosophy, if you understand their way of doing things, right, you're buying that performance. That's it. That's all you need to know.
All right. Well, let's go down and let's see what you should pay for Berkshire.
Yeah. So again, as we discussed, right, it's a little bit harder to kind of put the price tag on this company, right? Especially with such a diversified portfolio of both privately and the publicly owned companies, right? But at least we can try, I guess, right? So if we, for example, check their revenue for the past 10 years, let's have a look. What are we gonna see? Okay, so revenue was growing at about the pace of almost 6%, right? If we take the cash flow, let's see, 11%, right? So we can assume, let's say, the better, right? So let's say 11%. You think it's fair?
Yeah, for sure. But also, let me just quickly, maybe we can also check what the analysts think. Maybe they also have some take into account, of course, if there's any,
let's do that. So the way
discrepancy in performance.
Yeah. Yeah, so the way how we usually do it, or the way how Robin usually does it, is going to Yahoo Finance and we go to analysis, I think, right? Was
Yeah,
it?
yeah, that's correct.
Yeah,
Yeah.
and then we check it for the
Next
total
5 years, and
performance. Yeah,
then
yeah. So
but
you,
they have it's very high estimates, to be honest,
yeah, and
and
it's
they have
also.
been.
Mhm.
Sorry.
Yeah, it does also probably depends on the, let's say, the coverage of the company, right? How many analysts are looking into it, so it's
Yeah,
it's quite
but
debatable.
then we can see for the past 5 years, the growth estimates were at 12%. So it's again like 11, 12%. So 11% should probably do the trick here.
Yeah, right. Yeah. Okay.
Yeah.
Um, yeah, so for the P ratio, right? So if we go to macro trends, so the same story, we can just check what was there in the past. And then again, you're probably going to see the same story, right? At some point, you're going to have a lot of P ratios being almost at zero, right? But then at some point, when they're going to have some very good results, it can skyrocket, or it can just, flip
Yeah.
around. So, yeah, what do you think? Maybe the low of zero, which makes sense, and a high of 50 or 60, something like that.
Yeah, but we can trade them.
Yeah.
Yeah.
So 0 and 60, more or less.
So for your required rate of return, same story as always. If this is your first video you're watching from us, basically you want to see how much return you want, right? And because you expect between 7 and 10% annual return on the S&P 500, you want to have a bit more returns because yeah, you're taking more risk. So something you have to keep in mind, because yeah, you're stock picking, so you're not buying a basket like an ETF. So you are trying to hedge a bit against that added risk that you're taking. So you should also always note that the higher the returns that you are expecting, the higher the risk that you're taking. So for the discount rate, I always keep this at 11%. And then for the margin of safety, what do you think, Kirill? Because I think Berkshire has been here for years, and I think it will be here for years to come. They have huge holdings in huge companies, and I don't think it's going to go anywhere anytime soon.
mm-hmm.
So
Okay.
I think we can drop this a little bit,
To what let's say range would you be comfortable with?
somewhere between maybe 10%.
10%? Okay, sure. Fine. Yeah, this is also the thing, right? For you guys to understand what we discussed. If you understand the business well, and for example, if these recent news are not gonna, in your opinion, let's say, affect the operational performance of Berkshire, right? You could probably consider, yeah, that margin of safety can be, minimal in your case. But for example, if you're not very familiar with the business, you think like, oh yeah, that is a very big deal, right? Then you can just increase it, just to
Yeah,
keep your money, let's say, safer. Yeah.
exactly. So what would you say? What would your margin of safety be?
To be honest, yeah, I'm quite doubtful because even though, let's say, their investment portfolio is solid, but it is so big and it's so influential that it's already got to the point that it's like too big to fail, you know? And
Yeah,
that's what kind of concerning, because if there could be some very big, let's say, turmoil, like some black swan coming to the stock market or whatever, who knows what's gonna happen? And if, let's say, Warren and Charlie are not gonna be around, I am also not sure how the lieutenants will be able to manage that. So I would say, if, let's say, short term perspective, maybe in the upcoming 5 to 10 years, maybe it's okay. 10% is fine, but for the long term, I'm not sure. I'm not sure anymore.
okay, all right, yeah,
Yeah,
all
but
right.
let's
So
let's keep it
then,
at 10.
but
I think.
so for your discounted cash flow, what do you say? What number would you put to it? So then you would say for the short term, right? So you're thinking 5, 10 years.
Yeah, but then again, the problem is the fact that if you buy Berkshire, you buy it for long term, right? And this is
Hmm.
what you would like to also check your price upon. Um, but with the recent turmoil, it could be both. It could be maybe some opportunities for you to invest if, let's say, the stock is gonna drop because of this news, right? Or the other way around. All the investment sentiment is fine. People already got ready for these events. for the change of management. So we could try maybe 20 years. That's okay, and then we'll see.
All right.
Because 20 years is a long horizon, and then yeah,
Mm-hmm.
yeah,
Makes sense.
yeah.
Good. Click it.
Yeah, so now we click the analyze button, and let's say the way how this tool works, it's gonna take your assumptions, and based on that, it's gonna run the calculations through 5 formulas we got, and it's gonna provide you with the average of these prices, and with your target buy price, considering your margin of safety.
Yeah.
And you can
Okay.
see very interesting stuff, huh?
Oh wow. I wasn't expecting this, to be honest.
Yeah, I can
Yeah.
tell you
So
why though.
it's yeah. I can also tell you why.
Okay,
There.
be my guest.
Like on average, like most of the formulas are in the ballpark
Mm-hmm.
of where it should be. But then there's just some rule of thumb formula, and the intrinsic value (NPV) is just on the low side. It's just dragging the average down.
The thing is, yeah, because of the fact that the last year, so if we go up, let's say the free cash flow growth and revenue growth are off, right? The formula considers, the most recent years, and it takes that as a base point, right? And
Mm-hmm.
that's what actually drives that considerably low, in terms of evaluation. So what probably should have happened is that this could be the double. So the average valuation should be twice as much as what the tool is showing. This is also something for you to understand, right? So the way how these calculations are working, what's the thinking behind it, and it's also about the timing when you're doing your valuations, because for example the last year was a little bit off for Berkshire, right? But you also should kind of try to understand what's going to be in the future for the company, maybe even next year, right? And then based on that, try to do your, of course, further due diligence, and then do your price estimates. So
Exactly. So you need to see how much premium you want to pay for this company, basically.
yeah, and on top of that, understand where does this price come from? Why
Mm-hmm.
is it so low in comparison to the current price the market is paying, right? Because I would also say that I do not agree with this price. Just simply put, just because of just the formulas and the way how they work, and again because of the fact that Berkshire is not your normal business,
Yep.
but magically enough they perform very well.
That's how it is. All right.
Yeah.
So as usual, Kirill, show us where we can get the sheet. For
Yeah.
now, a sheet, right? Because we have some cool stuff in the pipeline
Oh
that
yeah.
we.
For now, let's put it like that, guys. As Robin mentioned, you can go to our lovely website 930.com, and then you can just go to and click on the Get Access Today button, and then you can just go and get it. So our usual price is 15 euros, but for now, because we're just trying to still grow it, to share it with you guys, and make it very easy and affordable in terms of as your first point of entry into the investing world, right? We just put it as a 1 euro. That's it. Just for you to test out, just to see around if you like it or not. Do you also feel like we're on the same page when it gets to our investment philosophies, and then you can just tag along. And yeah, one more thing, as Robin mentioned, we're also working hard on making this a web app. So making it all nice, all responsive, so that you're also able to use it on your phone, on your browser, on your computer, everywhere. So yes,
Exactly.
stay tuned. More news are coming soon, hopefully. So yeah.
Yes. So keep an eye on the website. Just a quick thing. So we already agreed that when you buy our sheet, there are no hidden things. So when you buy the sheet now, you're also included in any updates.
Yep.
So if you're thinking, yeah, if you think this sheet's already adding value to you, then you already know that that $1 might add some more value to you in the future.
Yeah. And if you also get the sheet now, as Robin mentioned, not only the updates but also like the web app, you're also gonna get
Hmm.
access for free. This is just for us, like just provide you with some incentives as the early adopters. I just wanna make it nice for you guys, even though the journey is a little bit painful, but just to stick with us for a little bit longer.
Exactly. And I think that's a nice note. Let's end it there.
Yep.
Thank you for watching. Leave a like and a subscribe if you like the video, of course. Leave a comment. if you want to have any discussions on Berkshire and its pricing. And then we'll see you in the next video.
Bye.